Welcome to Iron Financial. You know the deal here. This is the only place on the street where we forge a stronger portfolio by hammering right through the market's weakness. And today, we are putting General Motors on the anvil. Now, the story they are selling you, the one you hear on the news, is of this steel-framed American titan, stronger than it's ever been. But their own filings, they tell a completely different story, a story of, frankly, catastrophic failure. So we are here today to answer one simple question. Is GM a solid steel opportunity, or is it just a house of cards waiting for the slightest breeze to blow it over?
And that is the critical question, isn't it? Because if you just look at the surface, everything looks fantastic. But then you look at the one number that actually matters, profit, and suddenly the entire structure looks like it's built on sand. So is it all just hype, or is it real? Let's dive in and find out.
Okay, so let's start with the official story. This is the polished narrative that GM's management is pushing to Wall Street and to you, the investor. This is straight from one of their senior VPs. And you've got to listen to the key words here: strong demand, every price point, and momentum. I mean, they're painting this picture of a company that is just firing on all cylinders, an absolute unstoppable force in the market.
Right. This is the bull case packaged neatly into a single quote. They want you to believe that the engine is humming perfectly and the road ahead is just this wide open highway. But here's the thing you have to remember. A press release is not a financial statement. Words are cheap. We're here to see if the numbers, the cold hard facts, actually back up all of this talk.
And boom! Here is the reality check. This is the bucket of ice water. While their marketing department was busy writing up victory speeches, the accountants were staring at a bloodbath, a 55% collapse in annual profit. And let me be absolutely clear about this. That is not a dip. It is not a soft quarter. That is a complete nosedive. It's a 5-alarm fire raging in the engine room of the company.
This slide, right here, this is the entire mystery. This is what we're here to solve. How does a company that claims to have strong demand watch its net income get sliced in half? It just does not add up. This is the fundamental contradiction, and it feels like a crack that runs straight through the entire foundation of their bullish argument.
Okay. Before we call on a structural engineer to inspect that crack, let's give the bulls their moment. We have to look at the polished armor they're showing the world because, to be fair to GM, their sales report is legitimately powerful. It's impressive stuff.
You absolutely have to. You cannot just ignore the top-line numbers. They are moving an incredible amount of high-margin metal off the lots, and this isn't just corporate spin. These are hard sales figures. So let's actually walk through the highlights. Let's understand exactly why some investors are still willing to bet big on this company.
Now, what's really fascinating about this slide is the sheer, unadulterated market dominance it shows. They aren't just winning in a few areas, they are dominating the most profitable segments of the entire U.S. auto industry. Look, being number one in total sales is impressive on its own, for sure. But growing your market share to 17% in this environment, that is a real show of force.
And dive into the specifics, it gets even crazier. America's leader in full-size pickups for 6 straight years. Full-size SUVs? Get this, they have owned that segment for 51 years. That is not a winning streak, that is a dynasty. And we're not talking about cheap little economy cars here. These are the high-margin, cash cow machines that literally fund the entire company. This right here is the foundation of their fortress, and it is what's keeping them in the game.
And this, right here, this perfectly illustrates the point we were just making. These two vehicles you're looking at, they are the load-bearing pillars of the entire General Motors empire. The GMC Sierra and the Cadillac Escalade. These things are in super high demand, they have massive profit margins, and they are just printing cash for the company day in and day out.
The bull argument is actually brutally simple when you boil it down. As long as the American consumer wants big, powerful trucks and SUVs, GM is a money-making machine. Everything else is just noise. The question for us, though, is that strength enough to offset the rot we're starting to see elsewhere in the financials? Let's find out.
We have a saying around here, sales are vanity, profit is sanity. So it's time to pop the hood and see if the engine is really as strong as it sounds. We're done with the glossy sales brochure. We are now heading straight into the cold, hard numbers of the income statement. This is where the truth lives.
Yep, and this is exactly where the story gets ugly. This is where we find out if the numbers are telling a completely different story from the one that management is trying to spin. We are about to stress test the financial frame of this company. Let's see if it holds up.
Okay, just look at this table. Forget the victory laps from the sales team for a second and just focus on the data. Revenue, essentially flat. And let's be real, in an inflationary world, flat means you are losing ground, period. But that is not the real headline. The real headline, the one that should make you sit up straight, is the net income line, the bottom line. It plummeted from $6 billion down to $2.7 billion. That is a 55% drop.
And that net income margin, my gosh, it's horrifying. It was sliced clean in half. It went from an already thin 3.2% all the way down to a razor-thin 1.5%. Let me just put that in really simple terms for you. For every $100 of cars they sell, they are now only keeping $1.50 in profit. That's not a yellow flag, folks. That is a major, major red flag.
Let's just isolate this number so it can really, truly sink in. We're talking about over $3 billion in profit. That is just gone. It vanished into thin air in just 12 months. This is not a rounding error. This isn't just a bad quarter they can shrug off. This signals a fundamental, deep, structural problem with the business's ability to actually generate cash.
Right. So the question for any serious investor has to be, where did all that money go? I mean, it had to go somewhere. And maybe even more importantly, is this a one-time hit that they can recover from, or is this entire structure about to give way under the pressure?
So this is where the story takes a really bizarre turn. The numbers we just looked at strongly suggest the house is on fire, right? Profits have collapsed, margins are basically gone. So the logical response, the sane response, would be to conserve your cash, cut your costs, and basically batten down the hatches for a storm. But that is not what they did. Not even close. Instead, they stood up and announced they were going to start aggressively giving cash away to shareholders. It's almost like they're trying to distract us from the fire raging in the back of the house by throwing a huge party out on the front lawn. This is financial engineering, plain and simple, and it should make you seriously question management's motives here. And this isn't some small token gesture. We're talking about a massive $6 billion share buyback. Now, to put that number into perspective, that is more than double their entire net income for the year. And if that wasn't enough, on top of that, they're jacking up the dividend by 20%.
They're robbing Peter to pay Paul. It's the only way this math works. They are burning through their cash reserves, or maybe even taking on debt, to fund shareholder returns that the business itself absolutely did not sustainably generate this year. To me, this is a classic sign of a company in distress, and it's a huge red flag for any serious investor. Where in the world is the cash for all this coming from?
So to understand how GM can even afford this apparent generosity, we have to break the company down into its component parts. See, General Motors isn't really a single entity. It's more like a portfolio of different businesses. And to find the source of all this cash, you have to look at each segment individually and see which one is actually doing all the heavy lifting.
And more importantly, which ones are just dead weight, dragging the whole enterprise down. Let's peel back the layers and see which part of this business is the engine and which part is the anchor.
And here it is. Here is your answer. The smoking gun. Just look at the earnings power by segment. GM North America, which, let's be honest, is almost entirely their legacy gasoline truck and SUV business, generated over $10 billion in adjusted earnings. $10.45 billion. Now look at everything else on that table. Their international operations, it's basically a rounding error. GM Financial contributes, sure, but it's just a fraction of what that core business brings in. And Cruise, their hyped-up autonomous vehicle unit that we hear so much about, it's a cash incinerator. It's losing money. So the North American gas-powered business isn't just part of the company. At this point, it is the company. Let's just be blunt about it. That $10 billion profit engine from selling trucks and SUVs in North America is the beating heart of General Motors. It is the muscle that is pumping cash through the entire organization, and it is the only thing keeping this entire company alive and standing.
Exactly. Every other division, the international business, the big EV dream, all those autonomous projects, it's all either just decorative trim or in some cases an active drain on the company's resources. It's all being funded by this one incredibly powerful furnace. But the real question is, how long can that heart keep beating under this much strain?
So now we know where the cash for the buybacks is coming from, right? It's from selling Sierras and Escalades. The next question is the big one. Where did that $3 billion in profit go? We saw the collapse on the income statement. We know the legacy business is a cash cow. While that means something else in this portfolio must be a catastrophic black hole for capital.
Right, it's time to identify the real source of the cracks in this foundation. Let's find out exactly how $6 billion in profit turned into just $2.7 billion.
To find the answer, you've got to do a little digging. You have to go into the footnotes of the financial statements, and you look for a line item called special charges.
And you know, in the world of accounting, that's a very polite, very neutral-sounding term. But on Wall Street, a special charge is really just a corporate way of saying, we messed up, big time. It is the bill coming due for a really, really bad bet. And in GM's case, it's a very, very big bill.
And here is the number, a special charge for something they're calling an EV strategic realignment. And the price tag? Almost $8 billion. $7.914 billion to be exact. $8 billion. Just let that sink in. That's the black hole that sucked all of the profit out of the company for the entire year. This single accounting entry represents the cost of management publicly admitting that their entire grand strategy for electric vehicles, the very strategy they've been selling to investors for years, was a complete and utter failure. So what exactly is this $8 billion realignment? Well, it's not some small course correction. It's a full-blown strategic retreat. They are writing down the value of their EV factories because they now have to admit that consumer demand is far, far lower than they predicted. They're restructuring their money-losing operations in China. They're retooling crews.
This is a systemic admission of failure across multiple fronts of their business. It's like they built a giant church for a congregation that just never showed up. This is management admitting their strategy was fundamentally wrong, and now it's the shareholders who are footing the nearly $8 billion bill.
And there you have it, straight from the horse's mouth. You don't have to take our word for it. They stated explicitly, right there in their own press release. Net income was reduced by more than $7.2 billion in special charges. And why? Driven primarily by a realignment of electric vehicle capacity to adjust to expected declines in consumer demand for EVs. They are literally telling you, in black and white, that the entire profit collapse for the year 2025 can be blamed squarely on a failed electric vehicle strategy. This is a company that has been living a narrative, selling a story about the future, and now the hard, cold reality of the numbers has come crashing down on them. So what does this all mean for you, the investor? We've laid out all the pieces. You've got the dominant, cash-gushing legacy business on one hand. On the other, you've got collapsing profits and a nearly $8 billion hole where their EV strategy used to be. It is time to put all of these pieces together and forge our final verdict.
Yeah, is this a company on the verge of a huge comeback, having cleared the decks of a bad strategy, or is this a sinking ship that's just trying to patch its holes with shareholder cash? Let's break down the bull and the bear case one last time.
Okay, so the bull case is this. You are buying the steel frame. You are betting on that incredibly powerful, incredibly profitable truck and SUV business. It's so profitable that it can fund huge buybacks and not just survive, but absorb an $8 billion strategic blunder. You're betting that that fortress is basically impenetrable. And the bear case? The bear case is that you're buying the cracks. You're buying a company whose profits just evaporated, whose multi-billion-dollar pivot to the future just imploded spectacularly, and whose entire financial health now depends on a single segment, the gas-guzzling truck, that faces immense long-term regulatory and competitive threats. This is a high-risk, high-reward bet, and it is absolutely not for the faint of heart. So here is our verdict from Iron Financial. General Motors is a company at a major crossroads. They have a powerful, profitable fortress that is built entirely on gasoline. And the demand for their core product, their trucks and SUVs, is simply undeniable. But, and this is a huge but, they're using the profits from that fortress to fund an incredibly risky and, as we've now seen, a staggeringly expensive expedition into an electric future that they have yet to prove they can successfully navigate. The foundation is solid today, for now, but the cost of building for tomorrow is proving to be absolutely immense. And that leaves every single investor with one final, and I think, very provocative question. The old GM, the one that builds V8 engines and steel frames, is a cash-printing machine. The new GM, the one that's supposed to be built on batteries and software, just cost shareholders nearly $8 billion with very, very little to show for it. So the real question, the multi-billion-dollar question is this. Is GM going to be the next IBM, a legacy giant that successfully navigated a massive technological shift, or is it going to be the next Kodak, a dominant company that failed to adapt and was ultimately consumed by the very future it helped create? The answer to that question will determine the fate of this American icon.